credit spreads, these are the number one trades that we do here as CFU, and for good reason. It gives us a really high probability of success. So we're able to hit in that 80 to 85%. It does give us nice defined risk. And when I say that we're fully hedged is another way of saying with defined risk. And we know upfront what the credit is going to be when we get it. So that's another way of getting, hey, we know what our profit is, we know what our loss is. And if we carefully place that trade nicely, we can make sure that we're going to get good returns on our investment or on our trade, and we have a high probability of success. Most traders are going to bleed out. So this is a very important fact for everyone to realize is that buying options, the deck is somewhat stacked against you. You do need to have a nice big win or a nice big move. A day like today, actually, where the market absolutely ripped, we can go over and take a look at that right now, and I'll show some charts here. We had AMD absolutely ripped to the upside. So this is a really good trade that you could have gotten in on the long call option. So if you would have bought the long call here as it broke the structure and went above, that would have been payday for you for sure. This is coming on the backs of Intel having a blowout quarter. Do I have Intel on here? No, I don't normally track boomer stocks, so that's why I don't have it here, but we can just pop it up anyways. Intel, show us what you got. So they jumped up and then they had a nice North Star kind of candle pattern there where they have nice long wicks on either side. A lot of volatility as people tried to price Intel correctly, and they settled on basically the opening price is what they closed on. So coming in at $82, but that was a massive gap up. And what happened is they had a blowout quarter. So look at that. So they had an estimate of, you guys are going to make 2 pennies. They blew it out with 29 cents, a 1,500% beat, an absolute surprise on the upside, and revenue was extremely strong. So what's all this have to do? It's because CPUs, in particular, the Xeon processor for Intel is in high demand. All the agents, the AGI AI workloads, they require CPU to orchestrate or organize the workloads they're going to be doing for the day. That's why you saw AMD also rip because although AMD does a lot of GPUs, and that's been the focus of late, they do have CPUs, and they did just recently release the new Ryzen 9 processor, which is supposed to have some 3D V2 included in it. I don't know all the details, so don't quote me on that, but they have a new processor that came out that's supposed to do fantastic. We want more of the vertical integration or the vertical value chain, and we want to start building the chips and selling the chips. So they're going to get more of the profit and more of the return on well, a fatter margin on the products that they produce. And so they had a nice change of character back here where they broke above a previous high. And now they're getting 1, 2, 3 days in a row where they've just absolutely ripped. Personally, I am bullish on ARM. I want to see that continue upward. I'm also bullish on AMD. I'm less bullish on Intel. I don't know why, but it just has this old time feel to it. I don't like Intel very much. I prefer to go outside and go into the spaces like AMD for a kind of they have that bifurcation or they have dual strength within GPU and CPU. And what we're talking about is buying options. And we saw some examples there of particularly great trades that you could have made good money on from a long call option standpoint. But by and large, your best trade that you're going to be doing with options is to be selling credit spreads or selling options such as a covered call or a CSP, cash secured cash secured put. So let's focus on selling those credit spreads. So you collect the premium up front, and time decay is working for but selling a credit spread. You collect the premium up front, time decay is working for you. That's a very unique aspect of buying and selling options. You're probably used to buying and selling stocks, which have no time decay. Options always have time decay. So if you're the holder or you're long on the option, such as I bought the call option or I bought the put option, time decay is working against you. With a credit spread, it's working for you because you sold it. You profit in a sideways market, and then you have risk defined at entry. Sideways markets, man, it has been very difficult of late to keep a nice sideways market. It seems like they want to go down for a couple of days and they want to rip up for a couple of days and they want to rip down for a couple of days. by and large, over the longer term, we have had somewhat of a sideways market. I'm going to try and bring up SPX here. Good old SPX. Let's bring this up. I'll show you how this one has been much of a sideways market if you take a look at the top of recently. But now we've ripped to the upside. We passed above 7,000. Look at that. I just moved my mouse on there and we got it bang on with the 7,000 with a change of character, break of structure. And now we're ripping to the up there. So it has been, it's been very choppy, I guess, if you will. All right. So moving on. So what is a credit spread? Very good question. So a credit spread is an option trading strategy where you sell one option that is higher in premium and you buy with that credit that you got one option that is lower in the strike price. What this does is that generates the credit spread. So the spread is the difference between the two option strikes. You're selling the one that's higher, you're buying the one that's lower. The net effect is that you get a net credit into your account. You're using the same expiration date and the same option type. Those are all very important elements of buying or sorry, selling a credit spread. And as soon as this trade opens, that credit goes into your account immediately. So you'll see your account balance. If you just sell it for $125 or 1.25, you'll see in your account 125 bucks land immediately. And it's a credit to your account. Now you do have to hold some margin or buying power in reserve in order to hold as collateral for that position. Once you close out the position, that's when you get to release that collateral release that margin, and you can still get to keep that 125 or $100 or whatever the value was that came into your account. So if you want to see kind of a nice, easy build of a credit spread, here's one here. We can open up option strat and hopefully we can bring this one back. So if you look at option strat, let's go on the maker of the day, Intel, which is a nice stock to trade right now with it being 82, despite my disparaging comments on it. I know I don't like it. However, we can still show it and have a good illustration, especially with it coming up to $82. That's actually a really nice place to be playing because we can go to the 80. We can sell the 80 put spread there. So let's come in here. So we're going to add a position here. What's it got so far? Oh, it's already got let's delete these, remove this. And I'll show you just kind of how it works out naturally as you come in. So the first thing you're going to do, like we said, as a credit spread is you're going to sell the put. So you sell the put on here. Now it's been added to the screen here. I'm at $82.50. I want to usually stay out of the money. So I'm going to go down to $80 just to begin with. I don't know what my deltas are or any measurements like that. I come in here and I see Delta 39. Now, Delta 39, that's going to mean that for every dollar that Intel moves up or down, that the price of the option will move by 39 cents up or down with the underlying stock, Intel moving along with it. So what I like to do is kind of a nice rule of thumb is you want to do Delta 25. Okay. So Delta 25 means that you're going to go a little further out of the money. Oh, wow, it's Delta 35. So you got to go all the way down to 75. Yeah, see, now we're at Delta 27. We could probably even get away with 73. And what we need to do is select our strike price. So we had, I think it was May 15th there. Let's go up to June 18th. And look at that. You can kind of see here with these little dots here, these are the strike prices. Intel moved so much today that there's not a lot of strike prices up here because they're just more long-term hedging or speculative bets. And now we're getting up here. And so they're going to have to start issuing additional strike prices in here as we get closer to June 18th. So that's pretty cool to see how today we ripped so hard that we're running out of strikes, as you will. It's coming out of liquidity, I guess is what you call it up at that point there. So if we go to the delta, so 75 is going to give you delta 30. That's not a bad one. Let's go to delta 7250. Bang on. Okay, so we got delta 26. This means that we got a nice cushion out of the money. So we're $10 out, which is nice. And we're going to get paid, call it $420 to sell that option. So the market's going to pay that to us. So we add that one. That's the one we're going to short, or that's the one we're going to sell. And then we also are going to buy the put below it to give us a nice hedge. So we got A nice one here. If we go with the 70 on a 250 spread, that's the difference between the 70 put and the 7250. We're going to get paid $75. And so that's a pretty good return on our speculation or on our trade there. And so that's not bad to start off with. So you're going to get paid $75 and you're going to be, the calculator doesn't show. I'm sorry, guys. So 75 minus 250, or sorry, let's do, so we go 250 minus 75. That gives us a risk of $175. So then 75 divided by 175, going to give us a nice 42% return on the risk that we would take for this trade. So that's a good, decent trade, I think. And you can see here that this is where our profit and loss is going to, yeah, let's do that with this one here. So that's where our profit and loss is going to lie there. So anything above, just trying to get it bang on. Anything above 71.75 is going to give us profit, and anything below that will be a loss until it gets below our bottom strike there, and it'll kick in and limit our losses. So there. So that's where we like credit spreads so much, is that we have a defined profit. We're going to get paid $75, goes right into our account, and that gets keep that and hold on to it, and regardless of the outcome. So even if you lose, you still get to keep that $75. Now, they can't go in and take it away from you. What they would do is they would say, hey, you know what, you have to settle up and settle the trade and on this. And so if it goes down below into the 50s there, that long put of the 70 to help and monitor the trade and manage the risk that you would have on that position. Okay, so the bull put spread is just what we went over. This is when you expect the stock price to continue to rise or at least stay up. So we do have a bit of neutrality built into the trade. So if you come back here and look again at Intel, so we can sell that 75 put 7250. So we have it up here 7250 over 70. Let's do the 72.50 put. And the coordinates is 7250. So that's our nice upward range there. So we have all of this room above here will be profit for us. Now it just gapped up. So now that it's got a nice rip, and you can even put a flag on this. So this is going to be a flagpole on this trade here. I would give it a few more days on Intel to see how it's going to settle out. Is it going to keep on ripping up? Is it going to come back a little bit? I suspect I would like to see it do more of a bull flag pattern, something like this, like that. And that would give us a good consolidation time in here. Give the market, maybe we can tighten it up just a little bit. Give the market time to revalue Intel shares and say, hey, like, what's the true value of Intel now? And it'll give some time and some opportunity for it to consolidate. And then eventually it's going to either fall below or it's going to continue to rip up. The problem with this strong gap up is gaps usually like to fill. And so there's a really good probability that it's going to come and find weakness and people are going to be selling it, especially guys who are buying down here, right? They don't want to hold these shares forever. And so when it gets up to like this, it's like, man, I made my money, time to get out. So you should have some oscillation through here. So one of the, I think what would be a good trade on Intel is to see where we come in here. I would want to be selling that 85 call or maybe a little bit above, see if I could get something good on the 88. So that would be a bearish call spread. And we can go over that real quick here because I think it makes more sense. So the bear call spread on this one, this is illustration purposes. We're talking about selling the 100 call, but if we talk about what we have for Intel, what we would want to do is probably sell something around the 88 or 90 range, even if we came in through here. So we can flip this to a call. So I can switch to call, and then we can go up here. And what was I trying to do on this? Want to sell kind of like that 90 if I can. So let's see if that what they would give us for a June. See, this is where that liquidity problem on the spread comes into play, is that we have to sell the 90 and buy the 95. That would give us one. No, we got to sell it. Sell that, buy that. Yeah. Okay. So that would give us a 145 credit. That's nice. Okay. So I would definitely be looking at that. That gives me a lot of spread and room up top above here. It gives me a lot of time to say, like, Intel, look, that was a good jump and everything. And we're all really excited for you. that you need to get some consolidation in phase through here. It's very unlikely that it would continue just to continue to rip up on that one there. Okay. All right. Getting back here. So this would be, if we look at this, we would be selling this for, call it $630. And when I say that, what I'm looking at here is the 625 bid and the 640 ask, kind of coming in between that and be like, okay, I'm going to get that for 630 or 635. Nah, 630 for sure. And then I'm going to be able to buy this for probably 485 or 490. So you take the difference of those, and that's going to give you your spread difference of 145 here on the credit. Now, your maximum loss that you would have on that is 355. So you couldn't lose any more than 355. Yeah, this is kind of how it would work, right? So you sell that 100 call, but in the example of Intel, we're selling the 90 call, and then we're going to buy the 95 call above that. And that gives us our nice net credit here. In the example, I said 125, but in the real world example, we would be doing 145 here with Intel. So I think that would be a really nice trade. I might be looking at that here real soon. It's a little aggressive on it, but that's a good one, especially when it's up 25% in one day. What the hell, Intel? Well done, and it's about time. Okay, so this is another part of it that's amazing. So what we can do now, I want to go back to coin and IBIT. IBIT is the ETF that allows us to trade Bitcoin with a lot of liquidity. And just take a look at this. So if I had a naked put, we're talking about, let me try and get up. It's the best way to do this. Let's just bring up IBIT. So we have the ETF here, and we're going to do a cash secured put on it. And we'll just tighten up the strike. So we're trading at $44. So just do like the 42 on this, which I think that's roughly what the example was. That's kind of creepy. And then we'll just bring up the chart for IBIT. All right, here we go. Love this chart. See what I'm talking about with those flag patterns? So from here down, like you can just see it right away. There's this big gap down and there's that consolidation phase. Oh, no, not that. No, no, we don't want to do the Fibonacci sequence just yet. Okay, you go like that. And then from here, you can do another one out. And like that, right? So that's what you would have done as it had that big, nice drop down from here and found that consolidation and bounce back up, starts to build this flag pattern through here. You can also, yeah, then see it and then it broke down and that's doing it. Damn, like it's funny, right? You can almost copy this entire thing and put it down here again. So here you go. You know, it's not going to be precise, but I mean, it's there. I mean, you can see it, right? Dang. So what's going to happen now? So, I mean, I love Bitcoin, so I think it's going to actually find some support, do a reversal off this and continue to come up here. So the reversal will be confirmed if it was able to break this. That was the previous floor here. I'll put that on. Nope, wrong button. There we are. So right through here. So once it gets above this area, that's going to be our confirmation that we've reversed and that we're able to come back up, that buyers are able to say and justify why they should be paying this amount for Bitcoin once again. And if you're wondering the pattern of Bitcoin since the Iranian attack done, this is it here. So this is the more fluid chart with Bitcoin because it trades 24/7. So that's the cool thing. You'll never see a gap with Bitcoin because it trades 24/7. So you always have instant bid and ask and trades that are getting filled. They don't have, they don't have overnight delay. So this is when the U.S. attacked Iran on February 28th. That's where it kind of had that last low. This is one other thing that I really like about the Bitcoin chart where somebody, oh man, seriously, it's supposed to have it. Somebody was able to, right here. Yeah. Okay. So on February 6th, 2006, look at the low. I can't move my mouse because then it'll like mess up the chart. But look at the low. $60,001.00. It's right up there, right at the very top, kind of where that line, that dotted line goes to. You got the open, low, high, low, $60,001. That's cool, right? So somebody put through an order like, okay, right before it hits 60,000, I want to go in and I want to buy. That's a really cool lesson for a lot of traders to learn too, because as you get to it and it's like you want to fill an order. So you look at the book, the trade book, you're like, okay, a lot of traders are coming in and they're offering to buy at 60,000 or they want to buy at 59,000. You're like, dude, what's a dollar when we're talking about 60,000? So somebody's like, I want to be just ahead of those guys at 60,000. So I'll pay one extra dollar and I'll get all my order book filled at 60,000, $1 before anyone even gets touched at 60,000. Put you at the front of the line. So remember that if you're looking for, you see a really good full book of trade orders coming through at a particular price, and it usually happens at those psychological levels. If you're willing to just, hey man, like take an extra dollar or spend an extra buck, you can get in front of the line that's sitting there waiting for it at 60,000, or they're waiting in at 59,000. Designate, man, let's do one extra dollar and I'll get front of the line access. So remember that when you're trying to sell some of this stuff, it's really good. So we were talking about cash secured puts with Bitcoin. So when we're selling this 52 put, right? So we have to put up a collateral. We have, if it truly being a cash secured put, you're securing it with $4,200. If you're selling the 42 put on IBIT, and it doesn't matter how far out you go. If we go out to January 2028, you're still gonna have to put up $4,200. Now you're gonna get more net credit, okay? So you're gonna get paid $940, which is ironically 25% of what that collateral is, and that gives you a lower max loss, but you're gonna have to secure it with this. However, now this is where it gets really beautiful with put credit spreads is when I add that long put, I buy that and I put it just below my 42. Now look at that, my collateral shrinks to $200. And that's where the bull put spread or the call credit spread, this is where they get a lot of power is that I can define how much risk I'm wanting to take. And by doing that as well, I also define the amount of collateral that I have to put up. Yeah, overall, it's going to reduce your credit, but it's also going to be able to allow you to trade a whole lot more and have less buying power required to effectively do the same trade. And that's where these credit spreads can get so powerful. Okay. The bull put spread will have a much lower requirement for margin. And we just showed that right here, real time with Bitcoin. So the CFU framework. So what we like to do when we're trading stocks, you're probably wondering a little bit like, what's the secret sauce that you guys are using with CFU? So we do like to pick our stocks that we're going to be trading with. So me myself, I have 47, I think 49 tickers that I roll through, and I'm always like adding one, taking one away and stuff. But we have good underlying stocks that we're trading. They are good companies, and they have good underlying fundamentals, and they do have an element of beta to them. So we're not going to be trading a whole lot of those old boomer stocks. We will once in a while, but primarily we're going to be focused on the ones that everyone loves. And there's a reason why we love them. They're good growth opportunities and they're going to make a difference in the next 5 to 10 years. That means we're going to be trading the likes of Nvidia, Tesla, Apple, although Apple's kind of shrinking down just a little bit. Hopefully their new CEO can bring some AI livelihood to it. Like, let's get Siri AI working already. Like, how long does it take that? And we're going to be trading like ARM and others like Marvel, Broadcom, etc. A little less on the Intel. I'm not a fan of Intel for some really weird reason. I got a problem with that. Maybe I should look into that and get that solved. But that's how we do that. So we pick good stocks, we pick good strikes, we take on enough beta to make enough difference and enough return on the risk that we're taking. We do emphasize sizing the position correctly. Do not trade too many contracts. If you're starting with CFU, if you're a new member, as you get started, trade one contract. All of our performance metrics, all of the results that we have and that we share with all of the members are always based on one contract because we don't know how many you're trading. And so we just go with the absolute bare minimum, which would be one. And that's the size that we recommend until you get very familiar with our trading systems or you get very familiar with a particular trader and his style, then start to add additional contracts. Time the entry. So we also want to be selling into strength and we want to be buying on weakness. That's why when we're looking at Intel, like we were just doing a few minutes ago, we want to be selling that strength. So you just popped. The likelihood is you overshot that pop, and then you're going to kind of pull back and consolidate. So we want to sell that. We want to take advantage of that. when you get down into weakness like we had to go a week ago, a month ago, where there's so much uncertainty, that's when we want to be doing some buys. So pick that good company and pick that buy, right? And then define the exit. So all the time within CFU, we are always planning ahead. We are planning to exit the trade. We always have a limit order to get out of the trade and book that profit. And we always have a hedge, a long put or a long call to hedge our bullish positions if we're bullish. And then also, I guess if we're bearish and we have that call credit spread. But we always have defined risk when we're into our trades. So non-negotiable, this slide is a little bit wrong, so I apologize in advance. The short strike we want, it says here delta 15 to 20. I like to do a little bit more delta than that, so I would do delta 20 to delta 35. That's going to be a good sweet spot. That's a good balance of risk to reward. If you're selling short strike delta 10, that's a common delta for for covered call sellers to respect and to sell. I get it. However, yeah, sure, that's probably a good strategy when you're doing, I want to hold on to them. I don't want to have them called away. A really good way to protect that is to sell Delta 10, although you're not going to get very good income, right? So it's always risk reward with selling options. We do want to get you into that Delta 25. That's kind of the nice sweet spot there. A credit target, you want to be around 25% credit target of your spread width. So if we're talking about 5 width spread, so like we were just seeing with Intel, where we're doing the 80 and the 85 or the 90 and the 95, you want to be getting at least 125 for that risk. And 125 will represent 25% there. Okay. So that's a really good rule of if you're doing a 250 spread difference, right? So like we just saw there with IBIT, you want to be getting to 125 is a really nice sweet spot for that. And that would be 50% return on your risk that you're taking there. Position risk, make sure you're not doing more than 5% of an entire trade from within your entire portfolio. That's taking on far too much if you're at 5% for an option trade. If you're going to be doing a portfolio balance and like, hey, how much should I allocate to Bitcoin? How much should I allocate to Tesla or to Nvidia or to the S&P 500? That's up to you. But from an option trading standpoint, don't go over 5% on one particular option trade, because if that black swan event happens, you're going to regret having 5%. And if you have a lot of them in there, of say like 2 or 3 or 5 positions at 5%, and that black swan event happens, you're going to have some struggling difficulties with that 25% allocation to options on just 5 tickers. Okay. And just be careful that you're spreading out some of that sector risk. So don't all just be in semis, or don't all just be in power or all oil, or pick your poison, but don't do more than 5% on a particular ticker, and try and spread out the sector risk or the industries that you're investing in. Take profit. Here it says 50%. I think you can go a little further on that. I like to get 80%. That's where I always set my GTC limit orders to exit that trade for profit. So bump that up 25 to 50%. That means like you got the direction right and you're just waiting for it to close out. Get your 80% on that. Now, what's the takeaway lesson there? The takeaway lesson on the taking profit is don't wait for the trade to expire worthless. And I know that's going to ruffle some feathers. And a lot of option sellers like to have them expire worthless. This is the thing, that last dime, that last 15 cents on the option price. And if you've been selling options for a while, you know exactly what I'm talking about. That last 15, 10, and 5, that's going to take you almost as long as it took you to get there to begin with. Okay. So that last little bit of profit is going to take you about 33 to 50% of your time to get there. And during that time, you have gamma risk. Gamma risk is that tail event or that black swan or that gray swan event, like it just happened with today with Intel, right? So, say for example, you were short on a call option for Intel for Friday, April 24th. Let's go through this one. This will be a good example of it. So let's say you're coming in and you're like, hey man, gotta remove some of these. So say you had sold this, I don't know, what do you call it? 70, say you had sold like the 78 or the 80 call option on Intel. and it was so far out of the money, and you're coming in, and this is your last week here, right? This is your last 5 days of trading on Intel, and you sold this 80 call option a month ago, 2 months ago. This is where you have gamma risk, and this is probably when that option was worth 10 cents or 5 cents. When it gets like that, just close it out. Spend the $5, close out your credit spread, or close your naked call option that you have here, because these things can and do happen. And when they do, bang, you're pretty sad that you waited for that last dime or that last nickel, and then you got caught and it went up above you. Now you got to deal with this headache here. So that's why that last little bit of the option, you don't want to be around here for that. Okay, so let's get back into we're almost done here. So mistakes that can kill accounts, chasing high premium. There's a reason why somebody's willing to pay you really good money for that risky option trade. And it's because there's some risk that comes with it. So don't just chase high premium. If you are going to chase high premium, just make sure you have a call option to hedge it or you have an exit strategy for it. Okay. And if you're with us here at CFU, we do trade some of those high premium stocks. In fact, I don't know of anyone that we don't trade, but whenever we do, we always have a long put or a long call to hedge it and help us with it. Ignoring liquidity. Don't be trading weird stocks. Don't be trading liquid strikes. Don't get caught with a liquidity trap. Okay. And so make sure that the options that you're trading have an open interest, that they are being traded that day. They've some liquidity come through and people are willing to buy and sell options. You'll thank me when you get down to having to roll or having to close out that position. Liquidity can count to make a real big difference for you. Crowding the money, give some price and some room for your options to play and to go around. Okay. So that's what I'm saying here with that is a good example here with TSMC. And this one here, we have this is actually impacting me right now. We're short the 400 call option on TSM. Once it broke above the 50-day moving average and started to trade above here, I was thinking that it had to pull back here down to this zone here, right? Previously made this high, came back down, pulled back up. Even if you're going to do a cup and handle pattern, you still need to pull back down into here in this area, and I thought that was time to sell another call credit spread above it here. Now I'm in the money on the 400 option and I'm long the 405. I'm got the call credit spread of 400, 405. Okay. So, but before I panic and start moving on this, I got to give the price some time to breathe and to calm down. There's no reason that over the weekend there could be some geopolitical stuff that happens. Maybe a ceasefire doesn't happen or it doesn't get signed or something other happens, who knows what. It could also be, oh, wow, this is overpriced for TSMC. And there's no reason why I couldn't pull back and still make that handle pattern down into here. So give your trade some room to breathe, give your trade some time to play out and sell some time out there. Holding into expiry. So we already talked about that. That's that late gamma risk. You don't want to be holding on to that. Once you've got your money, you've made your profit, get out and don't oversize your trade. You don't want to be having too many contracts all at once and just make sure you're being responsible. Before your first trade, here's some tips you want to have. So you will need to have option level 3. You need to have a margin account. No, we don't borrow, but you still need to have that enabled features that come margin accounts in order to trade the trade options. If you are using a IRA or a 401k, I do believe the IRA does support this. Paper trade for 30 days, sure, give that a shot. But just know that some of the fills that you're going to get during paper trading are illiquid and not realistic. So just take that with a grain of salt. Get some fills that just aren't realistic when you are trading with real money. Most paper trading products are focused on stocks and less on options. Start with SPY in the queues. That's a really good idea because then you have instant diversification with the underlying ETF, and you also have nice liquidity and nice tight spreads. Risk 1% to start. Start with just one contract. And as you get used to option trading and feeling how they move and how they go, you'll be able to do more to portfolio. There's nothing better than trading with a community. We can help each other. We can help each other get better fills and better trading ideas and having like a hive mind, so to speak, as minds always looking around and looking for new trades and new opportunities and new risks helps everyone to trade better. So come on over, join our community. We're over at joincfu.com. You can start for free, but to get the best trade orders and alerts, you do have to be a subscribing paying member with CFU. and all of our pricing and details on that are available on our website. If you, like I said at the very beginning, if you're interested in just journaling your trades and having some assistance with that, go over to cfubook.com, and we do have a free trading book where you can use it. I use it all the time. It's mobile oriented, so it'll look really good on your phone while you're trading, and keep track of all of your trades. It's better than what they have with the broker because we're tracking daily that option trade, and we do natively support spreads and covered calls and PMCCs, or poor man covered calls, and we track that for profit to you. And we also support rolling and giving you that long-term profit on option trading as you go. That's it. Thank you for being with me. I'm Steven. I'm with Cashflow University. I'm the president of the business. And if any questions, head on over to joincfu.com, contact us, join our community, and we'll see you inside our Discord.